Good afternoon, everyone. This is Dave Keller from StockCharts.com here at the global headquarters in Redmond, Washington. Thanks for joining us for the final bar today. Ladies and gentlemen, this is what a down day feels like, so that's good. In 2 days of broadcasting, we've had a nice little up day and now a down day. We're going to break down the down move in stocks today, look at the more defensive play that we've seen from things like utilities and other more defensive sides of the market, and think about what that means to your long-term trends. Ladies and gentlemen, this is the final bar. Everyone, thanks again for joining us today on the final bar. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com out in Redmond, Washington. Thanks for joining us today. Boy, a lot of down movement today. A very different vibe on day two of the final bar from day number one, right? And again, it's okay. I think the key with days like today is keeping a proper perspective. And a lot of times we get so caught up in the short-term movements of the market, one of my friends used to call the flickering ticks of the market. You go so caught up in the short-term fluctuations that you forget to keep a proper perspective on the long-term trend. So the very first thing we're going to start today with is just a big step back. This is the last 7 years on the S&P 500. It's okay. The long-term trend is still very, very healthy. This is one down move, in a series of up and down moves, and all of those up days and down days cumulative over the multiple days, multiple months, multiple years are what create a long-term trend. And so far, it's undeniable that the long-term trend has been relatively healthy for stocks. But let's think a little bit about the day today and what that means, right? And again, just right about at the close here, around 2940 on the S&P 500. And if you follow candlestick analysis, this would be called a bearish engulfing pattern. On bar charts, you'd call it a bearish outside day. And they're very, very similar. So with a bar chart, you basically call an outside day where you have a higher high, a lower low, and a down close, right? So you have one day, you have a broader, more volatile second day where it engulfs or is larger of a trading range than day one and that down move. And so that is certainly a sign of short-term distribution. If you think about the short-term movement in the market, we'll look at just the 5-minute chart here real quick. You can see how that daily bar actually looks intraday, right? So we gapped up on the day, jumped up a little bit on the spiders, traded up for the first 15, 20 minutes, and then it was sort of just a consistent down move further and further to the low just after 2 o'clock. We recovered a little bit going into the close, but overall, certainly more distribution than accumulation. So this is why I have a lot of lines on my charts, and a lot of times when you see me bring up charts on the final bar, you'll see a lot of random notations, and most of these things are just my own notes on the chart about what I'm seeing. And I would encourage you, as you're using something like StockCharts, is use your charts not as a picture. It's not something you print out and hang on the wall. Use it as a notebook, right? This is your way of, categorizing and capturing all of your thoughts, sort of your experiences following a market. And that gives you the way. That's your report card. It tells you how you've done, but also gives you a way to measure how things are evolving. So this is a line that I drew a little while ago, taking it from the high from May, connecting it to after we sold off in August. You can see we recovered right back to that same level. We call that parity, where support becomes resistance and the opposite. And you can see that now a number of times we've come up to that level right around 2940, and a number of times we sold off from there. So it's not surprising to me that on a big down day, we go right about to that same point. And that's why I have a lot of these lines drawn, just to remember key price levels that are of interest. In the next segment, just as a quick preview, we're going to talk about thinking about price movements in particular for major indexes and looking at support and resistance levels and making sure we understand why they're sort of important. So what does this mean right now? Well, right now we're right at that key level, right at support level. We're also right below the 50-day, and I would not be too concerned about that just yet. I always wait for what I call follow through. So once you close through a level, the follow through would be tomorrow, right? Do we get some sort of confirmation, some further distribution, some further negativity telling us that that there's more sellers than buyers or something like that? or do we get some sort of recovery and then we have to sort of reset with where we're at? So that's sort of the way you think of a day like today is try to put it in proper context, try to take a step back and think about the big picture and how it relates to everything else. Not surprisingly, most global markets sort of looking more negative than positive. And again, this is the 30,000 foot view. The reason why I sort of look at things this way is just to see relative movements relative to one another. And this is a great way to sort of illustrate the US in the upper left, EFA, which is global developed markets here, and then EM, which is emerging markets, then frontier markets off to the right. Very, very different index, to be honest with you. But if you look at these first three, you can see why, as a US-based investor, it's paid to stay local, right? It's paid to stay closer to home because US stocks in general have held up pretty well. And these are all ETFs, obviously traded in dollars, so it's sort of taking that component out of it. You're just looking at, as an investor, if you were in one of these three markets, what would you have done? So think of this overall picture and how they're different, sort of something that's held at previous highs, something that made a lower high, and something that got nowhere close to its previous highs. And that's why it's been better to be in the US. But also just look at the most recent sell-off, right? So you can see that the S&P's pulled back a little bit right to the 50-day. EFA pulled back even more, and EM has sold off even more dramatically, now below the 200-day. So that's obviously more commodity-oriented global markets, and we can see how the closer you are to the US, essentially, the better that that picture overall has sort of evolved. So it's an important thing to keep in mind is just look at not just at an individual chart, but how the charts relate to one another. Just to finish off a quick market recap here, I also want to point out the movement in the fixed income market. So this is the TLT, which is the long bond ETF. There are a lot of ways we can look at bond prices. I tend to look at the TLT or the AGG, the AGG ETF. These are pretty broad measures of bond prices. You can also obviously look at the inverse and look at yields and see how those have come down. But if you look at the TLT in particular, we have the opposite to what we saw on the U.S. Equity markets, right? We have a bullish engulfing pattern, or what you'd call a bullish outside day. So a 1 day engulfed by the second day's trading. You can see how, again, if you knew nothing else about the world and you just looked at this chart, how would you feel about it? I'd probably feel pretty good, right? I mean, this is holding up okay. It's pulled back a little bit, but holding support very nicely. Had a big sell-off, but it's come off pretty well. So overall, it's kind of right at the 50-day, which is where it's been a number of times before this uptrend has resumed. So overall, you have this situation where you see short-term weakness in stocks, some short-term strength in bonds, or maybe more of a recovery type of pattern. And so those two together line up with what we looked at yesterday on the final bar, which was the ratio of the S&P, the spiders versus the TLT. We looked at the ratio of the one versus the other. And that's why that is starting to appear to favor bonds over stocks, because of that sort of rotation. So that's the way to think about it. Sectors have been really, really interesting. And just very quickly on the dashboard, just to show you, utilities and staples have been the top two places to be today. On the weaker side, we have the MEI trade, energy, materials, industrial, sort of on the weaker side of it, really down a pretty good clip, with financials down over 2%. So a big spread between the sectors. And I always remind people there's a lot of alpha to be made if you have a good sense of where the sectors are rotating, how they're moving relative to one another. So that's something I would certainly keep an eye on. Next, folks, we're going to talk about the mystery chart of the day. Now, the mystery chart is something that we tried a little bit on Market Watchers, and a number of you, I think, have been watching Market Watchers or watched it over the last couple of years, and thanks so much for doing so. One of the things I tried to introduce was this idea of the mystery chart, which was taking something, blanking out the ticker, and having you guess what you thought it might be. And then later in the show, we're going to unveil what this chart is, and we're going to talk about why it's an important one to pay attention to. So my question to all of you is, what is this chart that I'm showing you right now on the screen? I will give you a hint. It is not a foreign stock. That's probably about the hint I'm going to give you, I think. I'll leave it at that. If you're interested in guessing, feel free in the chat room on the StockCharts TV page. You can see the chat room on the right side of the screen. Go ahead and jump in with whatever ticker you think it is, and we'll take a look at those. And later in the show, again, we'll unveil what this is and why it's an important one to pay attention to right now. All right, I want to rotate to our next discussion. I wrote an article recently on Chart Watchers, which, if you're not subscribed to this is a free newsletter that goes out from StockCharts.com every Saturday. And so if you're not subscribed to it, go on to StockCharts.com, look for Chart Watchers, and you'll be able to subscribe for it very quickly over email. But myself and a number of other contributors, guys like Arthur Hill and John Murphy and Martin Pring and Julius de Kempener, Tom Bowley, people that I'm sure you know very well, all contribute articles to this every week or two. And it's our way of just sort of tracking what we're seeing and trying to, nudge your thinking a little bit, think about things maybe a different way than you have before. And I wrote an article for our last Chart Watchers publication called 3 Reasons Why Resistance Works. And I thought it was very timely to share it today, just with the sell-off that we have. For me, when we have a big sell-off in stocks, I always coach, novice investors, novice technical analysts, novice chart watchers to start with the current price and look to the left, right? Where are we at relative to where we've been? And starting there and looking to the left is always the best way to do it, in my opinion. And so what you're doing there is you're looking for what key levels you should know for the S&P 500 or whatever broad market index that you're looking at. So what I wanted to do is I was asked a question a while back about these levels, and I always talk about support and resistance levels on individual stocks. It makes sense because I think the market has a memory. So if you buy a stock at $15 a share and then it moves around a lot and it comes back to $15 a share, that price level has meaning for you. And for behavioral finance perspective, we call that anchoring, right? We anchor you, we prime you, or you prime yourself to a certain price level, and that then has meaning for you down the road. And if enough of us anchor to a certain price level, then it has meaning for the market as a whole. And that's why I would say support and resistance works pretty well on individual stocks. And I was asked, well, does that work on broad indexes? Because you're not really trading indexes, right? Indexes are a measure of a number of stocks and how they're doing. And my answer was absolutely, because of 3 reasons. Number one, you have to remember that the S&P 500, and I'm showing you a chart from the article here on the screen now, the chart of the S&P 500 really aggregates the prices of 500 or so charts. It's a couple more than that at the moment, but it's right around 500 stocks. And any broad index is going to have hundreds, if not thousands, of names that are rolled up into this index value. So if the individual price levels on individual stocks have meaning, I don't think it's that unreasonable that prices of a broad index or the level of a broad index should have meaning as well. And I think that's one of the reasons why you want to pay attention to these price levels. The second thing is, you're right, indexes are not tradable, right? So you can't buy and sell the actual S&P 500 index. It's a non-tradable security, but you can trade the spiders or the diamonds or the Qs or any of these other broad ETFs that track or tracking funds, mutual funds, whatever they might be, right? So you have a lot of ways of actually gaining exposure to the price of the S&P 500 or the value of it. And as the more and more investors use passive vehicles like ETFs or funds or things like that, I would argue that we're all now paying more and more attention to these levels, which means they should have more and more meaning for all of us, just like they do for individual stocks. The third reason why I think it's helpful is thinking about big round numbers. And it sounds kind of silly, but it is absolutely true. When a stock or when a market hits a big round number, that tends to have meaning for us. And there is probably no real meaning from a market perspective why a stock hitting 1,000 should matter, right? So as Amazon was rallying in 2017, it hit the 1,000 level, and look how many times it came right off of that point. And even when it blew through it in the middle of 2017, it came right back below and then kept testing it. And the argument for this is that, when the stock is trading above 1,000, we have to add another digit. It's, we start to sort of psychologically, mentally take a step back and think, wow, is this company actually worth more than $1,000 a share? That's a big jump. When it goes from 920 to 921, it doesn't really matter a whole lot. But when you're going from $999 a share to 1,000, that has meaning, right? That means something to us. It's the same reason why the Dow breaking 10,000 or 20,000 or at some point 30,000 would have a ton of meaning, because purely psychologically as humans, it causes us naturally to sort of reflect on whether or not it's worth paying so much. And again, if something's never traded that high and it gets up to that level, it gets above it, that's when we start to have thoughts like, wow, this is trading a little rich. 1,000, that's actually pretty aggressive, so maybe we want to hold off. So with a lot of stocks, when you see them approach a big round number, and the same with broad indexes, a lot of times you'll find support and resistance occurs just because we're expecting it, because psychologically those levels have meaning. Now that's different, just so you know, from something like a low price stock, right? Something going $3, $4, and then $5 a share. A lot of big institutions are unable to invest in stocks below a certain price level. So when something hits certain levels, you'll actually have an influx of demand naturally because more and more investors are able to access them. So I'm not referring as much to that. I'm thinking more of big round numbers like 100, like 10, like 1,000, 900, whatever it is. So that's what I would pay attention to. So the answer to that question of whether why does resistance work or how should it work on a broad index if it's not tradable, and I hope that starts to shed some light on it. I think there's three reasons. One is that it's an aggregate of all these individual names and what's meaningful. And then also it's reflected by the broad index ETFs and other products that allow you to trade directly or indirectly into those and get exposure to those indexes. And finally, it's sort of that psychological impact, the big round number, and when something hits a certain price point. If you're not familiar with that, again, that was on Chart Watchers that I put on there. You can go on to StockCharts.com and subscribe to that newsletter. I wanted to rotate real quick now and look at some of the individual stocks and see how they're at, and see if there are any that are near some key support and resistance levels. We're going to go through a couple of these, right? So Target, for example, is one that jumps up. This is toward the top of the scooter rankings, which is the StockCharts technical ranking, and it's an overall measure of technical strength. This is a stock, obviously, that's gapped up. We had the gap up a couple weeks ago, so maybe 6 weeks ago. The jump higher above 98. And then you can see it sort of rallied above there. And when this sort of pattern happens, there are a number of stocks that had been in really good places and now are sort of tapering off a little bit, sort of between key levels. This is where I think something like support and resistance becomes really, really important because we've now established a range, right? So now we have a level 110, above which you're unable to go. We have 105, 104, below which you're sort of hesitating to go. So those are sort of the range that I would keep in mind with a stock like Target. We're going to take a quick commercial break. We're going to be back with my guest, Jonathan Krinsky. Everyone, this is Dave Keller from StockCharts.com. Thanks so much for joining us on the final bar. I want to welcome on our guest, Jonathan Krinsky from Baycrest Partners. Jonathan, thanks so much for coming on today. I appreciate it.
Yeah, pleasure to be here, David.
So you sent a couple charts, which we've got on the screen, and love to get your take on what's happened. Obviously, on a pretty a painful day for people on the long side. You sent a chart first off with the Russell 3K. What are you seeing there?
Yeah, so I think this is a good example of why the market has had so much difficulty really sustaining breakouts over the last 18 months. And so the Russell 3K, for those that don't know, it represents 98% of investable U.S. equities. So it's pretty much the broadest measure of the U.S. stock market. You have all different market caps in there, et cetera. And what I'm looking at is a percentage of stocks within that are above the 200-day moving average. And the index itself is actually well above its own 200-day moving average. But internally, we have about 55% of components above the 200-day. That was actually before today, so we can expect that to go down. And basically what I've found is that to have confidence and conviction that any breakout on the broad market is going to sustain itself, you really need to have that measure above 60%, and really for more than just a couple of days. And if you go back and look at the strong uptrend we saw coming out of 2016, and then for most of 2017, you can see that for the bulk of that, we had well above 60% of issues above the 200-day. And conversely, over the last 18 months, we've primarily been below 60%. And I think that's, again, the reason that every time we kind of make this breakout on the market, on the S&P, it just seems to get a little bit above the old high and then fail and come back in. So I think that's a good reminder of what we're looking at under the hood here on the market right now.
Well, it's such a clear rotation from sort of the bullish phase on the left, more the bearish phase on the right, which is just how that's laying it out. That's a great chart. Second one was on the IGV equity.
Yeah, so that's the software ETF, broad-based software ETF, and software is important. So if we think about the market structure right now, we know there's 11 S&P 500 sectors, and then you break it down to the next level, and we get into the industry groups. And software is the largest industry group within the S&P 500 by market cap weighting. It's about 12%. So obviously a very important sector. It's been a leadership group up until, I would say, the last couple months. And I think it's at a very important and critical juncture. It's actually just kind of testing its 200-day moving average for the first time all year. Now it's still a rising 200-day moving average, so we could say that the primary trend for software still remains up. But if we look at the lower panel there, relative to the S&P, it's actually broken down to some multi-month lows. So typically, when you see relative strength breakdown, that's the first indication that the absolute chart might start to weaken. So I think software, it's going to be a critical juncture. And maybe as we get into earnings, we'll start to see if it's the start of a bigger rollover for software, or if it's just kind of a blip in that long-term uptrend.
That's a good one. And I've often told people the importance of looking at the relative strength, looking at the relative performance. That even feels like one where it's more of a leading indicator, right? You start to see the relative breakdown, and arguably you see a follow through with the absolute chart on the top, and that could be dangerous for one of the largest groups, and definitely one of the largest groups in tech. Final chart you sent was rails versus airlines, or what you called trains versus planes, I believe.
Yeah, so that's a trend we've been watching for a while. Obviously, those are both within the transport sector, very key sector. But I think sometimes it's nice to kind of get away from the overall market direction and try to find, interesting pair trades within sectors. And this is one we kind of like. So railroads have been a massive outperformer to airlines over the last 5 years or so. And that's really a function of railroads have been going up and airlines have literally gone sideways for 5 years. So if we think about the airline sector, a 5-year base, so it's obviously underperformed most assets, most equity groups. But we think that it's a decent place to go in. If the market's going to roll over, they're obviously not going to go up in absolute terms, but we think they can kind of begin to outperform in relative terms. And then the railroads we think are actually pretty vulnerable here. They got hit hard today. I think it was one of their worst daily declines in the last few months. We're starting to see some breakdowns. Union Pacific is one that's had a nasty breakdown below its 200-day today. So I think railroads, again, they were one of the leadership groups for the last 4 or 5 years. It's just an area to watch, and keep an eye on airlines as maybe if things do improve to break out of that 5-year base on the upside.
Those are 3 fantastic charts, Jonathan. Thanks so much for coming on. That was really, really helpful. And everyone, thanks to Jonathan Krinsky from Baycrest Partners for coming on there. It's interesting. We were just talking about transports yesterday in terms of the question we had was looking at transports and how they relate to the broad market in terms of Dow theory. Here's actually looking within the groups of transports, looking at the rails versus the airlines and getting some signal there. Jonathan is someone that I've enjoyed talking with for years and years, have followed his work for a while. He really knows his stuff in terms of groups and stocks. So thanks to him for coming on today. All right. Have you figured out what the mystery chart was? Now is the time, folks. We're coming back to the mystery chart. Do we have any guesses? Okay, we're looking at the list here. The XLF, a number of people guessed. The S&P 500, the spiders, a big bank perhaps. I give all of you pretty good grades for that. I would say Team Final Bar doing very well there. And many of you, it appears, were absolutely right. That is a chart of financials. I am desperately trying to find it. Here we go. This is not the exact same chart I might have showed, but something very, very similar. This is a chart of the XLF that you looked at today. And the reason why I think it's so important right now is because we were talking about support and resistance. That sort of ended up being the theme for the day here. And look at how important the resistance level of around 28, 25 to 28.50 has been for the XLF over the last 2 years, right? I've heard a lot of chatter thinking about, the return of banks, and is this the time to go, is this a huge inverted head and shoulders, a big low surrounded by higher lows? Is this the time as we break the neckline to sort of go bananagrams way higher and expect unlimited upside? And boy, today doesn't feel like that's what the pattern is telling you. So two things I would say. Number one, resistance levels like this are important because they tend to work, right? We come back to those levels and the market has a memory. So I would be very focused on the line I drew there. That's sort of the levels that I would be wanting to see the XLF break before I feel really good about further upside. Also, if we do trade a little further down, we'll have to see what sort of follow through we have tomorrow. But if we break the 50-day, you have to look at some of these lows, 25.75 perhaps on the XLF, and remember those key levels. So well done, Team Final Bar, on the mystery chart. The XLF was absolutely it. We're going to finish off the show today talking about the 3 and 3. So as I mentioned, those of you that watched yesterday, and thanks again, I hope all of you can go on this journey with us and join us every day for the Final Bar. What we're going to do at the end of every show is go through what I'm calling the 3 and 3. This is 3 charts in 3 minutes, and it's a way to highlight 3 key themes, 3 key visuals that I think you should be paying attention to if you're not already. So for today, we're going to start with a broad market index chart, and we're going to go very, very long term. So this is looking at the last 5 years. This is on the S&P 500, and this is a chart I call the S&P market trend, and it's essentially a way of measuring the long-term trend in the market. So if you look at what I'm doing here, weekly bars, the 21 and 34 week exponential moving averages, so really long term. We then have the PPO, which essentially is looking at the difference between those two exponential moving averages. And then we have the PPO, the traditional PPO, which a lot of people, you probably know it as the MACD. It's a same look, just a calculation. The numbers come out a little differently, but it's essentially a weekly MACD looking at where these trends are moving. And so the long-term moving averages, the 21 and 34 week, I sort of think of those as the long-term trend. As long as the 21's above the 34 overall, the secular trend's in pretty good shape because we're in a nice solid uptrend, and you can see that it certainly is the case now. And this would be above 0, the PPO, if that's the case. This one shows you more of the shorter term trend, more of the tactical trend within that long term. So the fact that we had a sell signal from the PPO a couple months ago sort of tells you the inherent weakness that happened back around here. It tells you the inherent weakness, and until that reverses higher, until you get a buy signal, it's not quite telling you that the tactical trend is positive. So it's basically reassuring you the long term trend is up and to the right. The short term trend is what we're concerned about. The second chart, chart number 2, is the new Dow theory. So yesterday we talked about Dow theory, looking at the Dow Industrials and the Dow Transports, or originally what Charles Dow had used, the rail index. So a new way of thinking about it, or a different way of thinking about it, is looking at the S&P versus the NASDAQ composite. So the S&P sort of broadly representing the old economy, and the NASDAQ composite broadly representing the new economy, and looking at the movements of these two. Similar analysis to what we did yesterday, and looking if they confirm or deny each other. And here what we can see is that both of those indexes have failed to establish a new closing high. Both of those indexes are now sort of in the middle of the range, and I would be watching like a hawk these lows from August. And if and when those levels would be broken, I think the markets are going to feel pretty painful, because that tells you a huge rotation and a confirmation between the two. But until you get that confirmation, the markets are holding up just fine from a long-term perspective. The third chart of the 3 and 3 today is looking at the dollar ETF, the UUP. You could look at the dollar index if you want. I tend to follow the ETFs across the board, just because there's a lot of good price data you can use across different types of charts. This is looking at the long-term trend. And again, I tend to maybe incorrectly think in my head that the dollar's kind of been holding its ground, that it's sort of been hanging in there. But the chart of the UUP actually shows you that it's been on a tear. It's actually been going up consistently. And if you look back for the last year and a half, the UUP is in a consistent uptrend of higher highs and higher lows. It's in pretty good shape. One noteworthy point here is the very last bar. This is today. You can see a lot of engulfing patterns. That shows you the rotation that we've seen so far in the markets. That distribution day, that bearish engulfing pattern, that bearish outside day, is something to be wary of. Ladies and gentlemen, wow. Again, 30 minutes goes by on a tear, but I hope this has been of interest with you. As a reminder, the Final Bar is on here every day at 4 o'clock Eastern, 1 o'clock Pacific. Our email is thefinalbar@stockcharts.com, and a number of you have been writing in. Thanks so much for your questions and your feedback. Really, really appreciate it. And again, we're just getting started with the new show, the new format, so would welcome any thoughts on how we could make this a more valuable time for you. But specifically, we're going to have a mailbag section a couple times a week probably, and if you have anything that you'd like us to unpack, uncover on the show, just shoot an email and explain what you have in mind, and we'd love to take a look at it. I would encourage you also, if you've not looked at our YouTube channel, if you look at YouTube and go to the StockCharts.com channel, you can always see some of our old videos. This is Dave Keller from Redmond, Washington, StockCharts.com.